All right, we're back for another episode of the Crypto Mavericks. And I'll tell you what, everyone, this is a great guest. We were having some fun before we started recording. We have the co founder, the CEO of Solstice Labs, Ben. Really happy to have him on. And he's going to really talk to us about all things Solana, but specifically DeFi. Ben, how you doing today?
Doing great, Brian. Thanks so much for having me on. And yes, lots of exciting movements in the Solana ecosystem recently to jump into. So happy to get kicked off here.
Yeah, and if anybody's who watches the podcast, if you're in our private community, you know that Joe and I are both huge fans of really a lot of different aspects of the Solana blockchain, and I'm sure we'll dive in a little bit deeper. But before we talk about Solstice Labs and how you've built that, I would love to know a little bit about your background. You have a really unique experience, if you ask me. So, love to know a little bit about your background and how did you even get into the crazy world of Web3?
Yeah, absolutely. So the background is, I'll try to summarize it here quickly. I had entered the crypto industry around 2013. I was a deep internet person, kid, teen across the board that got involved in a lot of different ways, transacting Bitcoin with friends, making little markets on the side, arbitraging different exchanges when there was truly permissionless access before regs kicked in. And I think I'll stop by saying that that was my involvement there on the Bitcoin side in the 2013 days before I get myself in trouble. But effectively, then it kicked off a lot within me because my background, it comes very heavily from a scientific mindset. Studied physics in college, was a published nuclear physicist, worked on particle accelerator labs, and I thought very heavily I was going to go into physics my whole life. It's a deep love of mine, and it's really that analytical mindset of just pulling apart something before you really understand it. It's really, at the end of the day, there's a lot of complexity around a lot of these topics, whether that's DeFi or physics or any of this stuff. And if you really know what you're talking about, or if you really love what you're doing on that passion side, you're going to be able to explain it in the simplest way possible. So whether if it was advanced quantum physics or whether if it's DeFi protocols, you strip it all down to what the core basis is. And that's a thesis that we build upon at Solstice, and a thesis I've lived my whole life. But as far as my background goes, like I mentioned, entered the crypto industry in 2013. My official career kicked off in TradFi as a swap trader on Wall Street on FX and swap and interest rate derivatives trading before moving into a string of companies across the both the blockchain, crypto, and DeFi spaces, very delineated there. And it kicked off with the introduction to R3, which is where the first efforts in that 2014, 2015, 2016 timeframe was really kicking off around institutional adoption and integration into the blockchain sector. It was all of these massive companies saying, how do we explore this stuff? How do we build upon this, right? And there's a lot of this institutional focus because that's where I really thought this is going to be the unlock for bringing us to the next level in crypto. Moved across firms, a company called DrumG, which was part of the Consensus Mesh, Consensus funded in the Ethereum ecosystem, built a private instance on Quorum of an OTC valuations application that ultimately merged into Credit Suisse. Afterwards was at Six Digital Exchange running their M&A as a director of M&A. Effectively on the Six Digital Exchange side, a lot of new crypto companies were coming in, delineating the value, figuring out exactly which ones we wanted to incorporate into the portfolio. And then finalizing that by working at Galaxy Digital, which I was on the global trading division, working on both strategic solutions and trading. And the highlight from that piece was again on this institutional crypto narrative. And that's where I led the first trade of a derivative settled in Bitcoin. And very excitingly, it was in the news, CNBC, et cetera. It was a very exciting trade. We counteracted it with Goldman Sachs. Still, I think one of the first only ones ever done in history for this type of trade with a bulge bracket. However, it wasn't really a good trade, being transparent at the time. And the reason being is because the industry wasn't quite ready yet. Liquidity levels weren't quite there, risk levels were too high, et cetera. But it's always been focused around this institutional crypto narrative. And then after Galaxy, I took 2 years in the mountains where I ran my own DeFi fund. Spent a lot of time climbing and skiing, but also really getting back to what I love is that degen, really feeling the market, yield strats, yield farming, going after these opportunities that are emerging. And while I was out there, I got a call from somebody who I've worked with, who's been a pillar in my career, Tim Grant, who is the CEO of Deus Ex Capital. And it was a call to join him and help run the fund at Deus Ex Capital between Tim and Stuart and looking over the investment decisions there. And while we were going through that portfolio, we saw the rise of these stablecoin introduced delta neutral yield plays and a lot of this, and it focused them on this institutional DeFi play. And that's exactly where I got involved. And we founded the company as co-founders, myself, Tim, Stewart, to effectively memorialize the institutional DeFi play around Solstice Labs. And that's what Solstice Labs does to finalize that story. We do two things. It's an institutional DeFi play on Solana, which we'll jump into on the stablecoin and yield side, as well as our staking business, but all focused around institutional DeFi.
We have some unbelievable guests on this podcast. Like being, we're closing in on 200 episodes. We've had some great guests, but that is one heck of a resume. And one thing I love about you is you're obviously a brilliant individual with that resume, but it also just talking to you before the podcast and even now, I do love how like you can put things in simple terms and just really deliver it in an easy way. And one thing I want to dive deep in is a little bit about DeFi, about yield, because that can become a little overwhelming for people. But before we dive into just kind of that whole aspect, tell me a little bit about Solstice Labs and, how that developed, what it is, how people can get engaged.
Absolutely. So Solstice Labs, very clearly what we do. We do two business lines as mentioned. The first is that we're offering a synthetic stablecoin on Solana and with an associated YieldVault protocol for all holders of that stablecoin, USX. The second business is institutional staking. In December of 2024, we acquired Bridge Tower Capital's staking operations, which include on-prem servers in Switzerland. We have a delegation from Lido of Ethereum that we stake through those servers, and overall services valuing over $1 billion worth of ETH and other services that are passing through the network. We offer RPC and MPC services, and just this month, we're happy to announce Solana validators in the US out of our Solstice staking business as well. Now, that core concept that I mentioned, a synthetic stablecoin on Solana with a YieldVault. This is where let's separate some of this complexity. Effectively, this model emerged where yield on DeFi is something that a lot of institutions and retail have been peering over the fence, and it's really only been for the people in the know to access these exciting yields in this wild west of finance. This DeFi side, everyone's been peering over and saying, how are they getting all these yields? Where is it coming from? Do I trust the system? Are the rails set up? Are my assets safe? And effectively, players had come out into the market that had simplified the investment process to get access to those DeFi yields. And what it effectively is introducing a stable coin as the capital introductory method. So you access the stable coin that's fully collateralized, and you effectively deploy that by locking it up into a protocol for yield over certain liquidity windows and for certain risk profiles. You receive that yield back, and you can do what you want with the additional returns in the core stablecoin itself. Now in USX and Solana, this is effectively what we're doing. We're issuing a synthetic stablecoin, which instead of a core vanilla stablecoin, we'll call them, it is not fiat-backed dollars. It is USDC and USDT, core, highly liquid, highly secure stablecoins that back USX, and it is fully collateralized with proof of reserve functions, pricing oracle, etc. All of the different rails that would prove that the assets are secure and that is fully collateralized. It is pegged to the value of the US dollar. That is USX, and USX is not inherently yield bearing. Do whatever you want with it. Lend borrow protocols, the communos of the world, all these different partners and dApps in the ecosystem, you can go utilize this across the ecosystem. Now, if you own USX, you can take the choice to earn yield. And how you do that very simply is you go to our dApp, you take your USX, you lock it up into the protocol for a minimum of 7 days. You can extract it out after 7 days, or you can continue to roll that. And what's happening in the background is that USX is being swapped into a liquid staking token called EUSX, which represents the yield being generated that rises in value. So if you put one USX in and the yield goes up to 1.01, whatever, you can extract 1.01 of USX out, which is immediately redeemable for USDC, USDT, whatever you might have. And that's how you participate in that yield. And then we can get into a conversation of how we exactly generate that yield, which is focused around things like what we call the delta neutral basis trade, as well as hedge staking. We have a bit of a dynamic blend portfolio that allows for a more comprehensive yield structure. And on the yield side, the core thesis is the delta neutral basis trade. Now, delta neutral just simply meaning we're not taking spot direction. And the basis trade effectively, it's an arbitrage of the differences of price between spot and futures that allows for that arbitrage to exist. And you're effectively extracting that arbitrage with not taking a positional and directional bet on the market over Bitcoin, Ethereum, Solana, a lot of the other majors, NEAR, et cetera, and others, that you're able to extract that arbitrage value out of and then pass that back to investors without ever taking a directional bet. And that's what makes up the core thesis of the yield strategy behind our YieldVault.
Amazing, amazing, and you nailed kind of one of my questions there, and you hit the nail on the head. Just kind of the difference between synthetic stable coins and just what a standard stable coin would be. But that really clarified it for me. So why'd you choose to build on Solana? There's a lot of blockchains. There's a lot of opportunities. Just curious about your overall thesis of the ecosystem.
Absolutely. So in the Ethereum ecosystem, that's normally where people's minds go with stablecoins. The market in stablecoins is over 120 billion in Solana, or sorry, in Ethereum. And in Solana, I mean, as of right now, we're just over that 13 billion mark. But since we founded Solstice Labs in September of last year, the stablecoin market in Solana has over tripled already. And we believe, in our core thesis, and my belief, is that the Solana stablecoin ecosystem will surpass the Ethereum stablecoin ecosystem in a 2 to 5 year run. That is easily something that I see happening. That trend line is growing because of really culture being the catalyst around the Solana ecosystem. I have a lot of amazing things to say about the Ethereum ecosystem across the board, but in its current state, we're seeing a lot of fragmentation. As Lily Lu said on stage famously, the president of the Solana Foundation, there's sharding of tech and sharding of community. Now, I won't position myself as biased against pitting these two. Obviously, there's strategic importance there. But what I will say is that we are seeing that fragmentation across the Ethereum ecosystem, which is not allowing for the composability of multiple apps and ecosystems and liquidity pools talking to each other. Solana, however, is all boats rise with a rising tide type of theory, in the sense that all of us are building solutions that are really supportive of each other. And I think that's really a function of the core ecosystem of Solana sticking together through quite volatile price movements we've seen all the way down to the drop in 2021, 2022, and back up. And now we're at a point where these apps are getting battle tested. Institutional flow is coming both from players like the VanEck of the world, from the ETF side, effectively that's going to get passed through and all the way, and also from the institutional capital entering DeFi through protocols like our own in the Solana ecosystem. We're seeing a lot of very exciting movements in Solana, and we're very bullish in the Solana ecosystem right now.
Yeah, we're bullish on it for a lot of reasons as well, and I think it gets a lot of attention because of like the meme coin hype and all these meme coins are getting launched, and it drives a lot of market interest. But go ahead.
I was just gonna say that's a really good point on the meme coin side. I just want to mention one thing.
Yeah.
It was incredible for that because of the traditional fast and cheap, right? It's fast and cheap comparatively. The transactions percent, TPS levels are through the roof comparatively to other trends, as well as the cheapness of the gas fees and the transaction processing on Solana. What's most important is specifically in the Trump coin example, which really blew out the numbers for volumes on Solana for all of this, as we all know, is one of the defining examples of DeFi in the last 12 months. What's most important about that is that it battle tested Solana for a massive increase of $12 billion worth of flows immediately, of being able to process this. Yes, there were small outages across application layers, but the core network and getting this up and running was one of the best testing scenarios that we've seen in Solana. And frankly, I don't think a lot of other L1s could have handled that volume in that time frame and that time scale in the levels that we saw. And it was a testimony to the level in which Solana is playing at right now. It was almost a bit of a testing ground. It's like, are you ready for institutional capital? And we proved with call it what you might, meme coin. We proved that we are ready for the next level for Solana, for Solana evolution.
That's an outstanding take. I never really thought of it that way, but that is one of the, I mean, it was just such a wild time and activity on the network. And you're right, that was one of the best testing scenarios for the entire network. Very interesting how you put that into terms. And of course, Solana gets a lot of attention because of the meme coins, but they're doing a lot of big things out there. And personally, I'm such a big fan of Solana. I always want to get my personal Solana moving for me. I'm always interested in stable coins, in yields. And there's something I can see, something on that's been talked about as YieldVault. Could you explain that into simple terms and what that makes, what it makes the yield generation model sustainable at the end of the day?
Absolutely. A sustainable yield is a very important thing to recognize here. So when you think about people wanting to get, in general, and I say people, both retail and institutions, if they want to get yield exposure in the DeFi sector, there's multiple ways in which they can do that, but many of which take on significant operational risks unless these individuals are well prepped and familiarized with the space. So having players like ourselves come in and create these models around accessing these types of yields on the delta neutral basis trade, for example, that we trade across all major CEX exchanges, that we trade using multiple different custody accounts, and these type of more complex and institutional grade trading scenarios Rather than set that all up yourself or have to deal with the complexities, we've already been doing this for 3.5 years at the DSX level, and we're effectively now offering that up to the general market. And that synthesizes in this YieldVault protocol. So all it is on the DApp, you'll have a one-click option to lock up your USX into the YieldVault. And when that happens, your USX token is locked up for 7 days, and the yield is generated and passed back to you in the form of EUSX, which is the liquid staking token of USX. And EUSX is just a representation of your holdings in the USX that rises in value depending on the yield generated. Now, when those collateral is deposited, those delta neutral basis trade, that functionality will continue to grow and will continue to be executed across all these major exchanges and passed back to the general community on a regular basis.
Awesome explanation. I really appreciate that for everybody in the audience. Another question I have for you, and I was thinking about this before we jumped on. What's like the current appetite between institutions versus, the standard individual or retail buyer for your current product?
It's a good question. So one of the major points that we're offering is that this is a permissionless product. And it's important for us to build upon the principles of why all of us listening and all of us in the industry, everyone on our team entered crypto in the first place. There were core principles of why we entered in this space. And a lot of people take these as lofty points or leave it for the discussions of the Tollies and the Vitalics of the world to discuss, but we should all be having this conversation at a build and operational level. What I mean by that is that the principles of being permissionless matter. So that means in our protocol, whether you have $5 or 50 million, you're getting access to the same yield rate. It's almost like a democratized hedge fund in a way. These high barrier to entry, these high walled gardens of just getting access to these investment strategies have been so protected by high yields and high capital introductions that it's really excluded the common investor. It's excluded the retail market. And that's not the principles of crypto, and that's not what we should be building and catering towards. So this permissionless product is really diversified across both sides of the investment perspective. Now, with that being said, who are the types of investors that are coming on and what's going to drive this? We've seen models across the board on the Ethereum ecosystem, which is why we're so excited to launch this on Solana. In the Ethereum ecosystem, it was championed by Athena, followed by Resolve and Parity and Usual and Falcon and all of these guys that are constantly coming out and really attracting this type of yield generation on the Ethereum side. A lot of the movement in the initial stages is bootstrap TVL by institutional investors so that you get that stability in the coin liquidity pools, the money market making funds, etc. You're starting to get that stability of a liquidity ecosystem in place. And then when the retail really catches traction, sees that growth, you start to see this massive trajectory of retail exposure that pour in, knowing that it's a stable place. Some people take those earlier bets for points programs or others, but you really have to get to a certain point of stability before you see the retail market really explode into this product. And that's where effectively we're going to be following that same growth trajectory with a bit more structure and also jump started by DSX's capital. We're going to be committing 100 million of our own TVL at launch to jumpstart this protocol as a commitment to both Solstice and the ecosystem. We're putting our money where our mouth is, to be frank here. So.
Yeah, that's awesome. I mean, committing 100 million to the TVL is definitely, exactly what you said. You're putting your money where your mouth is, and that makes anybody in crypto or anybody that's exploring different platforms or protocols. I'm attracted to somebody or a company or a founder that's, hey, we're committed to this. We're going to ride this out for the long run. And hey, you want to see me do it? Here's $100 million in TVL to get started. It's almost a no-brainer.
I couldn't agree more, because one of the things on that point, just to elaborate, is like we've seen a lot of yield plays as well do something similar, which I've been kind of turned off by, which is some of the model that we're changing. A lot of listeners, for example, might be very familiarized with the delta neutral basis trade or this yield model. And so for those listeners that are, when you really think about this model, a lot of protocols have come out with an overly boosted yield, which is short liquidity caps that allow for this highly boosted, non-sustainable yield model. And it's usually a combination of double dipping in the core yield fund as well as offering TGE incentive boosts that effectively run out after a certain period of time. And after that happens, there's no core utility in the stablecoin. The investors go to that one and then they move to the next and they jump from yield to yield. We're not building in that model. We easily have the optionality too, being fully transparent. And any builder in this space does have the option to do that. But that's the old world of DeFi. That's the Wild West perspective of DeFi. DeFi is graduating a bit. There will always be these crazy, exciting yield opportunities of triple-digit returns and all this if you're really sophisticated in the DeFi sector. But for the general market and of attracting net new capital in and still maintaining an attractive yield that's still multiples higher than the treasury returns, this is where we're going to really not launch the TGE for our own protocol at launch, but delay it for 30 to 60 days. Focus on getting the Solana ecosystem right before any access from bridges, swaps, et cetera, down the road, and really focus on doing this in an institutional longevity play way. And how we do that is structuring organic, natural, and sustainable yields for the ecosystem.
Yeah, that's great. And I've been on that other side as well, kind of chasing yields, and it's some outrageous yield at one point, and then I check it like an hour later. I'm like, what happened? And it creates it's a little bit of a headache. And then if you're not really Web3 savvy, there's another layer there that it's just like, why even get involved there? So that's why I'm so interested in what you're building. Are we getting to a point in the future here where just traditional asset managers are going to start using on-chain yield protocols?
I absolutely, well, first and foremost, it's already happening. Second off is I think trend is going to continue categorically so, but DeFi is starting to see a bit of a split right now in my mind. And you're starting to see protocols, L1s and foundations in some scenarios build towards effectively supporting the traditional TradFi ecosystem. What I mean by that is catering to all of the KYC rules, catering to all of the different risk control laws, etc., getting really built and stuck into the traditional system, which in a lot of ways has the check marks for investor security and safety that are great. Down the road, we'd love to see a world where the second side, which is where we're in this bit of a hybrid model, but the permissionless access, the fully decentralized and secure aspects of these protocols really can come about to evolve into these completely new fund structures that we're just now starting to see for the first time. And it's going to take battle testing even further for aspects like pricing oracles and aspects like proof of reserve functions and the custody accounts to ensure that investor funds are safe and that yields are being transparently and sustainably accessed by the clients, the end users. So it's one of those things where you're starting to see a bit of a split between how products are being built in the DeFi sector.
Absolutely. And since we're talking about, well, we were talking about stable coins, and you obviously know a ton about them. Talk to me about the stablecoin regulation bill. It's been in the news quite a bit over the past couple of weeks, past couple of months. Would just love to know how you view the entire news cycle there.
Yeah, it's a bit interesting, right? So you have the genius, well, primarily in the US. I'm originally born and raised in New York City, even though I live in Europe now. But the born and raised in New York really has me tied always to the US regulation. And the US regulations around stablecoin bills is really going to dominate effectively the narrative around these stablecoins, primarily because of the fact that 99% of stablecoins are still US dollar denominated. Whether they're pegged directly, whether they're synthetics, it's all US dollar based. We haven't seen that pie chart break down further yet. It's continuously dominated by the US dollar. So with that, you have the Genius Act and the Stable Act. And even though the Genius Act just recently got denied in its first round of passing through, a lot of times in US regulations, as we all know, people pack in 1,000 things into these bills. And if you look through it, there's a lot of other things that don't necessarily correlate to these stablecoin aspects. And I'm under the belief that it wasn't the controversy around the core stablecoin aspects. It was really about some of the other points that were in the bill. Now, with that, over time, we believe that the US, as we've committed to Solana validators in the US as well, we do believe that the US will have a regulatory shift towards a much more positive crypto ecosystem. And what that means is effectively breaking down the original barriers that the US has put up because they quickly realize crypto doesn't care. If you want to shut us down, we'll move. And crypto is going to exist before and after governments in any region of the world. And with that being said, you realize that it's better to be congruent with them and to be working with them on a day-to-day basis to really find the best solution possible. That's the reason why we're a Swiss AG, for example, as a topco level, as well as other these regions in the world, the UAE, Switzerland, Singapore, even Bermuda, places that have really evolved their digital asset strategy early, have seen the benefits massively to their GDP, to local business growth, to international business activity, because they were on the leading edge of designing thoughtful digital asset practices and thoughtful crypto practices for how businesses can interact in the country. So the US is finally catching up to speed on that, and hopefully we'll see both the Genius and Stay come through and benefit the crypto ecosystem, which in my mind is going to cause one hell of a crypto summer if it does.
Yeah, I sign me up for the crypto summer. I'm excited for it as well, and I have my own bullish takes there. And I love what you said there that crypto doesn't care. That isn't that the truth? Like,
Crypto
it's
doesn't care.
I tell people that all the time, like who are like my buddies who are like asking me because I work in the industry, they want to ask me questions about crypto or like, what if the government tries to shut it down or do that? I'm like, listen, man, I know you're just getting into it now, but they've been trying to shut this down for years and years and years or put walls up. I was like, it's again, crypto doesn't care. Companies will move, people are going to transact somewhere else. It's like you either embrace it, you regulate it, you adopt it, or you're gonna get left behind.
Exactly correct. It doesn't address the issue as well. Like this will always precede everything that we just said, of course, but there's also the raw fact. Massive wealth center in the US that does need these regulations in place to unlock net new institutional capital from the US to get those, excuse me,
Sure.
flows into DeFi. And so we still very much need to see that happen. That is categorically correct in order for these really to unlock the next wave of institutional adoption. And what I mean by institutional adoption has to be very clear because this term is thrown around loosely, and I've been yelling institutional adoption for crypto since 2015. And if there's anybody that's sick of the narrative, it's myself. But what it means specifically this. Institutional adoption does, in my mind, I'm not talking about the VC investing, the PE investing. I'm not talking about the R&D budgets expanding. I'm talking about real investment dollars, front office investment dollars being deployed for real yield and real capital recognition in the spaces, including DeFi directly, not crypto applications that are supportive and directly integrated with TradFi. I mean core DeFi applications. That's the spirit of this net new institutional adoption of crypto. And that's what we mean at Solstice Labs by institutional DeFi.
Yeah, great point there, and you hit the nail on the head because there are some things that we want to get over and bring in new users and just new money into the system, and we need some regulation and some clarity there. But I'm a big fan of it at the end of the day. What's your personal long-term vision for DeFi, and how do you see Solstice Labs fitting into that?
There's an entirely new investment fund structure that's evolving right now that we're really exciting to see. And in Solstice Labs, we're really championing that fund structure by doing the things a bit more transparent, a bit more sophisticated as far as a regulatory regime goes, a bit more battle tested as far as all the pieces to the puzzle coming together in one comprehensive fund structure. Whether you call it a DeFi fund, an on-chain asset manager, a yield protocol, the name in the industry is still to be determined of what these funds effectively do. But you're going to start to see a much broader range of risk profiles, much broader range of yield opportunities, and it's going to become this completely liquid marketplace for individuals to just come in and access yield in just the same way people are enabled on a day-to-day basis to go invest in SPY off of their brokerage accounts on their phone. The same way you're going to be able to think, I want to go generate passive income in the background. I want to go generate yield on my assets. And I want to also principally protect my assets against things like inflation, for example. You're going to direct those into DeFi funds, DeFi yields in a much broader strategy way. And in the DeFi world specifically, this is where players like ourselves are going to be one players of many, of course, and we hope to get the mind share in the market as much as we can, as all the other players will. But it's that variety aspect that'll decentralize and a non-localized risk across the entire industry that is really going to take us from where we are today to where we want to go tomorrow in DeFi.
Awesome. How important is community involvement in what you're building, and how can everyday users participate or even contribute?
As I said earlier, specifically to the Solana ecosystem, which I'll highlight, culture tends to be the catalyst. When we talk to our partners across the ecosystem, whether that's dApps, DEXs, moneymakers, etc., all of these different players are constantly communicating, constantly building each other up to support each other to drive flows into the Solana ecosystem. And that mindset of just that, look, if you benefit, we benefit. If we start to think of these non-traditional corporate egotistical structures of high barriers to entry and high barriers to partnerships, etc., if we break those barriers down, you're starting to see a massive amount of effects that are synergistic. And Solana is a great example of that. You don't see a lot of these L2 rollups that start to have fragmentation and non-composability and non-transactions between liquidity pools. You start to see a completely integrative model across multiple sides of the industry at once. And effectively, that community aspect, and what the nice part about community is they'll never lie to you. any protocol, anything that comes out and they try to oversell or they're trying to do things in a certain direction that is a pure money grab or one player take all type of mindset, that immediately gets called out consistently. And we see that time and time again. And the community is always honest. And if there's anything you can do, you can always trust the community to keep you honest in this market.
Yeah, especially in the crypto world, they'll chirp you if anything looks irregular, or they'll absolutely let you know. Finally,
Absolutely. And
what?
we need that.
Oh, yeah,
I was just saying we need that. We need that.
exactly. We do, because that puts a layer of competition that makes products better, that makes founders better, all the above. Finally, what's next for Solstice Labs in 2025, and what's most exciting to you?
Absolutely. So as far as the community update goes for where we are at Solstice, we're going to be coming out with our official launch this summer. And so stay tuned for that. You can follow solsticelabs.io on the website, as well as our Twitter account for the direct updates. But we're going to be launching the core product, the USX stablecoin, as well as the YieldVault protocol into market this summer with full permissionless access to both retail and institutional investors. That'll be accessed via our DApp and via OTC contracts for the institutional side. That'll all be accessible this summer. Down the road, what I'm very excited about is integrating these yield solutions into things like PayFi solutions. So Solana PayFi is one of the most exciting narratives coming out of the ecosystem right now. And what I mean by PayFi is also interesting concepts that can come out of payment integrations and payment services. For example, the buy now, pay never aspect. We're going to offer there's a bit of a teaser, but we're going to offer an example of this into the market, which I won't tease out too much now, but it's effectively going to say, if you wanted to purchase something on a website, let's say a t-shirt or a sweatshirt, rather than pay capital that leaves your wallet and you get a good for that wallet, you're effectively taking your capital, locking it up into a yield protocol or a staking protocol, for example, and the yield that's generated pays off exactly what you purchased and you receive your initial capital back. Now that's exciting on a retail level to a certain degree, but also for major purchases. We have a Deus Ex Pay group internally at the Deus Ex portfolio that handles crypto payments. An example, they handle consistently high net worth type of transactions, private jet purchases, real estate purchases, yacht purchases, etc., as well as general retail fiat to crypto conversions. That business model, for example, a high-end real estate deal, a high net worth individual wants to come in and purchase a real estate transaction and have a monthly mortgage payment off of that, they can pay that off with the yield with never putting new capital down to effectively transform their capital efficiency model and also principally protect it against inflation. Those are new models that emerge out of this PayFi sector that have never been done before, at least in a way that really makes sense to the end investor and is clear and transparent. So when we think about what's next for Solstice, is we're going to be championing a lot of these efforts, specifically in the Solana ecosystem, to start and really get that tangible end user value seen on day one. This is not your traditional magic beans bag grab yield play that we've seen time and time again with a lot of DeFi yield protocols. This is going to be the long-term play that we're building for, and we're thinking 3 to 5 years in advance, not what's going to get our bags up in 3 to 6 months.
That's amazing. That PayFi tease was great. Buy now, pay later, and you gave me an example on the retail level, and I was like, "Whoa, that's awesome! That's a really cool idea?" And then your next example was wonderful. That's something I'm definitely going to be interested in. I love what you're building. I love what you built. Really going to be watching it closely. Would love to give you one more shout out to either have people be able to find you and especially find Solstice.
Absolutely. So the shameless plug is we got solsticelabs.io, our website. Check it out for all the up-to-date information on the protocol. Also solstice_io on X. Feel free to follow that for updates across the teams. And then I'm at Ben_Solstice on X as well. So lots of Solstice branding everywhere. But stay touched. We have a Telegram group set up for announcements, and we will be announcing our airdrop program over the summer as well for longer term incentive plays for those that interact with the protocol. So stay tuned.
Oh, awesome. And everybody who wants to interact with that, wants to check out Ben, wants to check the platform out, I'm going to put all the links down below. Ben, really appreciate you jumping on today.
Thank you so much, Brian. Always a pleasure.